All right, today we're going to do a deep dive into a market DNA cycle analysis, specifically for the DJ30. Think of this as a documentary-style walkthrough. We're going step by step through the model's application using the direct source materials for this documentation. Okay, let's get into it.
So the analysis you're about to see, it all uses the proprietary market DNA geometric system. And it's really important to keep in mind, what we're doing here is purely for documentation and for public verification. This is not financial advice in any way.
So here's what we've got on tap. First, we'll look at the specific DJ30 cycle that the model identified. Then, we'll really get into the nuts and bolts of phase one, the entry, the risk plan, and the potential targets. And to finish up, we'll map out how the rest of the cycle is documented to unfold from here. All right, let's set the stage. The whole reason we're here is that the model has identified a specific cycle for the DJ30, and that's exactly what we're going to be breaking down today. Okay, so this slide right here, this is our starting point. We're looking at the DJ30, and the analysis date is February 23rd, 2026. The key thing to know is that at this moment, the price has met the exact conditions to kick off what the model calls phase one.
So let's dig into the details of this phase one setup. This is where everything is laid out. We're talking about the identified entry points and the full risk management plan that goes along with them.
The first piece of the puzzle here is the primary entry. You'll see it on the chart marked as M. The model flags this initial entry point right at a price of 48,754.8.
But that's not all. The plan also has what's called a secondary entry. It's labeled PC, and it's set at 48,258.1. Now, this is super important. This is not a new phase. It's an optional entry point that's built right into the risk plan for phase one. The price might hit this level, or it might not.
Okay, so here are the specific inputs the model uses to calculate the risk for this cycle. It all starts with a hypothetical capital of $100,000, with a max allowed drawdown of 5%. The time frame, which the model calls the trapezoid time duration, is set for 33 days. Then you have these other parameters, the third triangle domain at 3.62% and a risk coefficient, or R, set to 2. And finally, a contract size of 10 units.
So how do all those numbers actually get used? Well, the model documentation is very precise on this point. Both trade sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size.
And here's how that calculation plays out. The model first finds a mean entry price, sitting between M and PC. From there, it defines an expected low price. All of that crunches down to a size of 1.42 units, which then gives us a total position size of 0.14.
And after all that math, it all comes down to this one number. The risk plan specifies a size of 0.07 for each of the two potential trades. Simple as that.
Okay, so we've got the entry and the risk plan locked in. Now, let's look at the other side of the coin, the potential outcomes. This section is all about the price targets and the different scenarios that the model identifies for phase one.
So the model defines three very specific price targets. Target 1, or T1, is at 49,104. Target 2, T2, is at 49,629. And this one's interesting. It's called a safe exit point, located at apex N. And finally, target 3, or T3, is at 50,160. This represents a full exit when the price reaches the top of the trapezoid.
Now, based on those targets, we get two possible scenarios. And the difference between them is actually pretty straightforward. It all depends on whether only that first entry, M, gets triggered, or if the price dips down and also activates the secondary entry, PC.
Let's just put these two scenarios side by side. In scenario 1, you only get one trade from the M entry. That position is documented to exit at target 3 for an expected profit of $983. But in scenario 2, both trades are executed. The first one still exits at T3, but the second one takes that safe exit at T2. And that, as you can see, results in a much higher expected total profit of $1,942.
Now, if we take those projections and annualize them over that 33-day time horizon, the difference really pops. Scenario 1 projects an annual return of just over 10.8%. But scenario 2, if it plays out, projects nearly double that, coming in at 21.45%.
So that's the complete setup for phase one. What happens after that? In our final section here, we're going to lay out the sequence of phases that the model documents for the rest of the cycle.
According to the model's documentation, there are basically two potential paths the cycle can take from here.
The normal path is just what it sounds like, a straightforward sequence from phase 1 to 2 to 3 to 4. But there's also an alternative path. And in this one, phase 3 could actually happen before phase 2.
So what are the triggers for these next phases? Well, phase 2 officially begins when the price makes contact with the mirror delay line. Phase 3 is triggered by a very specific N-level event, which is just the price reaching apex N. And the whole cycle is considered complete with phase 4, which happens when the price finally hits the top of the trapezoid.
And that's really where this documentation leaves us. We've seen the entire setup, the risk plan, the targets for phase 1. So the only question left is a procedural one. How will this documented cycle actually move through the model's defined phases?
Before we sign off, just a few quick but very important disclaimers. Please remember, this presentation is only for documentation and public verification. This is not financial advice. The model's rules prohibit any leverage above 10 and also prohibit investing essential personal funds. And finally, any risk management must follow the model's instructions to the letter. Thanks for tuning in to this explainer.